We are joined today by three of our regular guests: Vandana Hari, founder and CEO of Vandana Insights; Andy Lavan, CEO of Sahara Energy Resources; and Randall Mohammed, MD of Petro Industrial USA. Thanks very much, everyone, for joining us this morning, November the 3rd. Vandana, let me go to you first. We've seen oil prices. We have got a little graph up there from yesterday, from earlier this week. We're talking about wage inflation, and we'll be talking about that later on. Fed not seeming in full control, but we'll address that question later. But Vandana, let's start with oil prices. Seeing a retreat overnight this morning in Asia, quite significant in percentage terms, I suppose, compared to what we've seen recently. Why?
Hi, good morning and afternoon from Gurgaon in India. So indeed, we're seeing a bit of a pullback today, which seems to be an immediate reaction to the API data that comes out after the close of futures markets on Tuesday. And quite a significant rise, and unexpected, I would add, rise in overall US crude inventories. Cushing inventories, which have been quite a bit under the spotlight for draining pretty fast in the past few weeks, have declined, but again, much smaller number, less than 1 million barrels. So, and then distillate stocks are also up. So overall, the market seems to have taken a slightly bearish signal from that. But that's just going to be one of the factors impacting the oil market sentiment this week. Of course, as you just mentioned, there's the Fed meeting result later in the day. Perhaps that's a little bit on the periphery of the oil market, but I would venture to say that if there are any nasty surprises, especially from the Fed, the investors lose their risk appetite, let's say for whatever reason, because of any interest rate hike signals that they don't like, that could accelerate the pullback from crude. But then, of course, we also have the OPEC
meeting.
We've
got OPEC tomorrow, exactly, just to go on to that. So, I mean, we know we have the OPEC meeting until this week. The expectation has been that they're going to hold to what they're planning. But do you sense any extra pressure at the COP26 now? You've got extra, the US again calling on meeting with the UAE yesterday, obviously pressuring, listen, please, can you increase a bit more, just at least for now, to temper these prices? Do you think anything's going to come from that?
The pressure is not new. As we know, the so-called energy crisis rally in crude is now more than 6 weeks old. And pretty much throughout this period, there has been pressure bearing down on OPEC Plus from the US, Japan, and India, most prominently these three countries. But equally, I think we have seen a pushback, quite vocal and public rebuttals from, especially the Saudi energy minister, whose word carries a lot of weight, without doubt. But we've also seen in recent days, Kuwait, Iraq, Algeria, Nigeria, all throw their lot behind the narrative that Saudi Arabia is maintaining, that the world doesn't really need more oil, they still need to be cautious, COVID is still around. And, the problem is gas and coal shortages, and it would be wrong to throw more oil at this problem. Perhaps we should talk a little bit later about is OPEC Plus really capable of ramping up much more? I think that is a key issue as well. But I'm not expecting any surprises, dare I say that. I am expecting them to stick to their current tapering path for December.
Sure, we'll talk about that. And we've, of course, mentioned that on the program here, that in the immediate aspect, only one or two members at OPEC Plus can increase immediate supply. Randall, let's go to you with that. But putting OPEC Plus countries aside, let's talk a bit about US shale, because, we've obviously been mentioning that with you on this program and others, that, with these high prices, why isn't it coming on sooner? Yes, everyone's saying it's going to be ramped up by the second quarter of next year. But are we going to see some renewed impetus on perhaps seeing more shale come to the market sooner? We had BP CEO Bernard Looney yesterday talking about how in 2022 they're going to increase their investment in their shale assets by $500 million from this year. So are we seeing some renewed impetus there?
Hi, good morning. Good morning, everyone. Look, that's a good question. And I was quite surprised with the announcement of BP coming back into the shale plays in the US when we saw a few of the super majors exiting the shale. I think Shell sold out most of its assets in the Permian. But nevertheless, look, I think the trend of producers giving back to their shareholders continues. I think, U.S. producers, similar to the Middle East producers, are certainly enjoying the higher prices. We've seen a lot of the majors, Chevron, BP, announce very healthy profits for this quarter. So, having said that, I think if this was a couple of years ago, we would see shale come back a lot quicker. But I think, the headwinds and the pressure of trying to, decarbonize and the rest of it, that's certainly putting pressure on the shale producers. But I think slowly but surely, we're going to see shale come back. The rig count is still pretty low compared to years gone by. It's not drill, baby, drill like years gone by. I think the emphasis is still more on drawing down on that inventory of DUCs, the drill but uncompleted wells. And I think you'll see that trend continue at least into the last quarter, probably into the first quarter of the new year.
Okay, Andy, I'm just sort of on that same point of tight supply into the first quarter of next year, which I don't know, again, I'd like to have your expectation on whether you think that's still the case from OPEC side, from shale side, whether we're still kind of looking at a pretty tight supply scenario into Q1. But, a bit of a contradiction from Bernard Looney, actually, because he said that, yes, we're going to pump a lot of more money into shale next year. But also when, all these windfall results we saw come out of Q3 results for some of the majors, including BP, saying they're not focusing on new investment in conventionals. They're going to be, paying back their shareholders with nice dividends. So, where are majors at, do you think, on that journey of new investment versus, keeping their shareholders happy?
So I actually think it's relatively simple. It's all about cash. Okay, so if you are a cash-strapped mom and pop shop who's got some acreage and needs to go to the bank to get financing, it's tough. If you're a major and actually all you need to do is just pump some money into completing a well and you get paid back in a year, then you're going to do that because that's what the shareholders want. All of this noise, all of this blah, blah, blah about kind of energy transition, which is a word, that's a phrase that's been created to hide stuff, is irrelevant. It's all about cash. So if you can get a return on your dollar in 6 months to a year, they're going to do it. Now, you can strategically make a decision to get out of something to create some cash to put something else into, which is some of the oil majors are doing. But anybody who's holding on to shale is going to be looking at this and saying, do I have the money to complete it? Can I sell it at these prices? If the answer to those two questions is yes, then you're going to do it. And therefore, you're going to put money and you can get payback. Okay,
and how much pressure, immediate pressure? I mean, again, it's a long-term play. Let's talk a bit about COP26 because we're there this week and next week in Glasgow, and all the majors are there, representatives and government officials. We've had also cash flow coming into the big companies. At the same time, we're getting them under sort of pressure to not invest anymore in conventionals, and you must be investing, as some of them are obviously, in cleaner fuels. So how do you see the majors, Andy, defending themselves now with this big cash cow, in terms of their long-term clean fuel investment versus clearly opportunity in the immediate sense on conventionals?
So again, it all comes back to cash. What do you do with the cash now? How long does it take you to get the money back? And how do you keep all the stakeholders happy? So if you can make money now and you can push that money out to your shareholders, that's one group of stakeholders that you can keep happy. If you can then talk to the governments about this is what we're doing, we're cutting back, you've got some of the oil majors actually talking about we expect to produce less oil and gas in the future. To a certain extent, that is a bit of a smokescreen. to a certain extent, it's testing the waters to understand what they need to say to keep all their stakeholders happy. So they're playing a very difficult game in terms of how do you balance the short-term needs of the people that have got shares, who just want dividends. I mean, if you're in an oil company, if you're invested in an oil company, you're not interested around what they're going to be doing in 20 years' time. You want to get my dividend. I want my 5% per annum from BP and Shell, and that's all I care about. The bigger things are then how do you put that cash to use in longer term projects? And that's where it's more difficult. So if you're putting something into a new oil field, you're not going to get payback for 15 to 20 years. If you're putting it into Shell, you're going to get it into a year to 18 months. So it's a different decision. Then if you start to say, okay, now how do I get into the greener energies? It's a third conversation. It's a conversation I don't think many of the major oil companies are really very comfortable having, because they actually don't know. They don't have the experience base of, okay, so if I start investing in a wind farm or I start investing in photovoltaics, how am I going to make this work? You know, if you look at BP were in solar, out of solar, back in solar, because it wasn't matching up to the metrics of investing in the oil space. Well, now there's a whole bunch of people have come along and actually probably are further ahead than a lot of the international oil companies in terms of those alternative energies. So it's a very difficult investment question. Do I do it myself? Do I buy companies? What do I do? Because unless they do something, inevitably in the long run, they will have a problem because there will be nowhere for them to go.
Yeah, and unlike Vandana, back to you, unlike OPEC plus national producers, you know, they've got to make the most of the immediate sort of next few years of demand for conventionals. They're not going to change their strategy that significantly. Vandana, let's talk a little bit about just sticking to supply tightness, you know, against sort of demand expectations, if you like. We've seen demand outlook revisions in the last couple of weeks, sort of the reality of, yes, things are slowing down a little bit compared to the sort of post-COVID bounce, if you like, that we saw. Are those quite settled now in the market's opinion? I mean, and how is that impacting the worries of the immediate sort of energy supply crunch this quarter and next?
Yeah, no, I think the disparity, first of all, between analysts, and even if you're looking at EIA, IEA, and OPEC views, the disparity between their numbers and the flux in their own estimates, I think it's far from settled. So indeed, as you just mentioned, in fact, the OPEC technical committee caused a bit of a ruffle in the market as well. Last week, you know, news agencies reporting that they had revised upward the shortfall that they see in Q4 this year to something like 1.1 million barrels per day. And then this week, you know, they revised it back down to 300,000 barrels per day, which to me, frankly, was quite suspicious. You know, you go from a 1.1 deficit to 300,000 barrels per day deficit. But I think to some extent, this might simply be because, you know, it would look bad, you know, optics-wise, for OPEC's technical committee to conclude that the deficit is going to be this wide in Q4, and then the OPEC ministers meeting and saying, oh, no, it's quite all right, we're going to maintain our 400,000 barrel per day monthly increase. So it might be partly optics, but partly it might be simply that, and which I think is probably the bigger case, that a lot of oil market participants and observers are still struggling to understand exactly how much more oil demand is being caused by the shortages of coal and gas, I guess, which is far more difficult to estimate than how much more demand is being generated by the world quite rapidly returning to normalcy. I think the latter is probably a more cut and dry case. I think nobody would dispute, as we are sitting today, COVID does seem to be in quite a sustained decline. And it is more than wishful thinking from what I can see. Demand is certainly picking up, mobility is picking up, curbs are being eased. We have a flare up again in China, but do you even see it anywhere in oil headlines anymore? So, you know, China is asking refiners to ramp up. It's releasing petrol and diesel from stockpiles. So overall, the narrative is that Q4 is shaping up to be very strong on demand. And if OPEC Plus maintains its very conservative course of easing, that there is going to be shortfall. I think exactly how much of a shortfall there is going to be, still remains to be seen. I think also how severe the winter turns out to be, is anybody's guess.
Yeah, Randall, just on that point, okay, COVID, as Vandana rightly pointed out, seems to be on the decline, at least with the figures that we do have access to out there in certain regions. And things are sort of coming back to normal. But what isn't back to normal are supply chain channels and the blockages there and the backlog, let's say, of what was caused by COVID. Most people in the market agreeing this is going to take at least 12 months to clear and to get back to normal. Ships waiting outside ports now, multiple ships, shortage of staffing. How much is that? We're used to that now. That's kind of the scenario for the next few months. Have oil markets and others adjusted to that? And how much is it impacting people's forecasts and how it's going to impact demand or supply plan?
Yeah, and I think that's part of the transitory inflation that the Fed chair has been speaking about, this sort of constraints in the supply chain, which eventually will sort itself out. I couldn't say exactly when. It could be 8 months to 12 months. Part of the inflation narrative is the supply constraints. The other part of it has to do with liquidity in the system. And, the whole process of tapering really would be to sort of withdraw some of that liquidity from the system and sort of help ease some of that inflationary pressure. My forecast is if they start the tapering process in November, my forecast is that they'll probably try to do it on a $15 billion per month basis over an 8-month period. That's going to take us into June next year. That will be the first step. Then I think they will only consider interest rate hikes thereafter. And I think that's going to come no sooner than 2023, after they've digested the tapering process. That's my best guess.
There is our survey question for the day, which addresses exactly what you're talking about. Will the US Fed try to convince the markets that tapering and rate hike can be decoupled? I mean, we know obviously we've got the meetings today, obviously later in the US, where they're going to perhaps pinpoint an exact date when they're actually going to start that tapering. I think the markets have baked in the fact that it's going to start either in November or December. But the big question now, as you said, is inflation and the rate sort of increases. And again, many opinions on that. But the decoupling of those two, can Chairman Powell today convince the market that those two can be completely decoupled? Can he postpone that rate hike talk? Andy, let's go to you on that. How would you answer that question? Or has it already been answered by the US Fed?
I think it is totally uncertain. My biggest concern is that actually we've got used to low interest rates, and it will be very difficult for any government to really push interest rates up to probably where they need to be. My little anecdote, my daughter's buying a house, her first house, and it's very difficult in the UK to buy a house. And you look at the interest rates today and compare them to what they were when I bought my first house. They are chalk and cheese, right? And we saw tripling of the interest rates when we bought our first house. So I do really worry that actually all of the developed world is going to struggle to push interest rates up despite inflation. And that is going to lead us into some very difficult territory.
Okay, what do you mean by that difficult territory? What impacts are you going to have on economic growth?
Well, so the problem is if you've got a good environment and you've got low interest rates, that's great for growth. But actually what you'll then start to see, you'll see inflation. And if you can't push up interest rates, it becomes very difficult to actually control that inflation. So interest rates are the way you control inflation. You stop people spending money by putting the interest rates up. And if if especially the developed world has become used to these really unusually low interest rates, that's going to be a problem, because if you then start to see interest grow up, you may find that actually there's an overreaction, which means that the interest rates actually don't go up as high as they should do.
Vandana, on that point, in terms of oil market reaction and the Fed policy that we've seen outlined so far and going forward, let's make the assumption that it's still going to continue to have a soft approach to interest rate hikes. We'll talk more about end of 22, 23, and even then, minimal rate hikes, because they're just simply too scared of what the fallout might be. What is, from an energy markets point of view, oil price point of view, immediacy, what sort of, is that going to sort of cause any nervousness, or is that good news?
Yeah, good question, Diala. So until this energy crisis started, let's call it sometime in around mid-September, one saw quite a close correlation on a day-to-day basis, sometimes even on an intraday basis, between what the mood was generally in the financial markets, and of course, that, which in turn was being affected by all the macroeconomic data. Macroeconomic data generally was quite good throughout the summer months, the reopenings and all of that. However, every downturn or dip in sentiment and investor risk appetite typically came from sudden fears over what the Fed will need to do because of inflation, and of course inflation data, what the Fed will do, and what an interest rate hike, a premature interest rate hike might do to recovering economies. And those times we saw, every time the risk appetite went down, we saw crude responding in a similar manner. It does seem to have decoupled quite a bit ever since the energy crisis began. There's, in fact, two sort of decouplings, dichotomies that I have noticed. One is, of course, with the financial market sentiment. The crude complex doesn't really seem to be too worried about what's going on there. That goes for both when it is up and it is down. And the other is, it even seems to have decoupled from what's happening with coal and gas prices. So if you look at benchmark, Henry, on a day-to-day basis, what Henry Hub is doing, what Dutch TTF gas futures are doing, or what the Zhengzhou thermal coal contract is doing, all of them have pulled back tremendously from their recent highs, but crude has gone in the opposite direction. So coming back to the financial markets, which is what I said earlier, I would think that pretty much whatever is like expected, baked in, if that's what the Fed delivers, then I don't really see crude responding to that. I think crude complex will probably keep an eye on what the EIA data is, and then after that, what OPEC does. But should there be a nasty surprise, and that's the only thing I can think of in terms of an outlier event right now, in that the Fed ends up scaring the market quite a bit with regard to whatever signals of potential rate hikes, maybe one, maybe two next year, and there is a sudden loss in risk appetite, and then the sell-off could spiral into the oil market. But then again, just to close that thought, I think crude is still, pretty well supported on this entire energy crisis rally and the speculative buying as a result of that. So even if there is a knee-jerk sell-off, I expect crude to clamber back out of it.
Yeah, and I suppose fundamentals are still supported into at least until
exactly
supply comes on. And let's talk a little bit about that, Randall. We've mentioned this before, but in terms of OPEC plus supply, we still have the issue of certain members of OPEC plus not being able to increase supply as we speak. Is the market sort of still taking that into account, or does it see, for example, Iranian supply or other supply coming on stream sooner, Nigeria, etc., even Mexico, in that sense? Is there any more hope of that additional capacity being available sooner than was expected perhaps a month ago?
Yeah, no, I think there's definite constraints in supply, Nigeria, Angola, just to name a few. But, I think the US administration also believes that, Saudi, Kuwait, and the UAE has that extra capacity. Saudi Arabia did not get the term swing producer for nothing, right? 2 million barrels per day of spare capacity. You've got 300,000 barrels per day between the UAE and Kuwait. That's 2.6 million barrels per day of spare capacity. The question is, are these countries willing to toe the line? You know, are they willing to turn on the spigots and release that supply into the market? My guess is not at this point in time. I think these countries will continue to enjoy the higher prices. We saw the Saudi government announce for the first time a fiscal surplus. You know, that's fantastic for them. I think right now it's less about balancing the market and optimizing revenues and income. You know, let's face it, you know, oil hit negative prices back in 2020. Brent sunk to, you know, maybe $19 per barrel. You know, these countries simply have to claw back what was lost in 2020. So, you know, I mean, yes, President Biden he's on OPEC. He's you know, he wants OPEC to open up the supply. It's falling on deaf ears, and I believe that, you know, the priority right now for those countries is to really optimize the income. And, you know, if I was sitting in the Ministry of Energy in Saudi Arabia or in OPEC, I would agree with that decision. You know,
okay.
Let's
optimize. Let me just come back to your Biden. He's not going to have any luck trying to convince OPEC what to do. And what about domestically? What luck is he having there? I mean, he's at COP26 right now. And again, I mean, he seems to be giving a mixed message. We'll talk about domestic in a minute, where he's at with the infrastructure bill. The opinion is it's going to get passed in one way or another, but after a lot of compromise on his part. They've dropped a lot of demands. But at COP26, again, Biden's there. You know, his whole agenda for election was climate change. He came down hard on some of the US drilling rights, etc. But at the same time, we have an article today on our bulletin saying that there's new land leases up for you know, exploration and production in the West, in the US, you know, and that the administration is sort of still going to assess whether that's possible and how damaging climate change really is. You know, what is his stance? Has that weakened his stance on coming down hard on the oil companies in the US?
Yeah, you know, I think, look, I think in the long term, his green policy will stand and he will continue to push that green policy. But certainly in the short term, you have to understand that the United States consumes around 420 billion gallons of fuel. It's a motoring society, right? You know, right now, gas prices on average are about $3.40 across nationally. That's pretty high compared to last year when we saw fuel prices dip below $2 per gallon. So I guess definitely in the short term, he is going to press OPEC and insist on more supply so that he can reduce those fuel prices. Now, let's not forget, the national holiday, Thanksgiving, is coming up this month. So I suspect that those refineries are you're going to see probably a drawdown on crude within the next couple of weeks as refineries prepare themselves for the holiday travels. Now, let's not also forget on November 8th, the president is going to announce that he's going to reopen borders for non-essential travel. So that definitely is going to push up demand. In fact, we are seeing a lot of the Canadians come down to Florida already. And I suspect from November 8th, there's going to be a flood of millions of Canadians into the US. And that's going to increase mobility, yeah?
Yeah, and let's talk about that. Andy, go to you for the last minute. So to talk a little bit about, there's our poll result. Will the US try to convince markets? Can it actually convince the markets, basically, rather than will it? Probably will try to. Yes. Okay, so that seems to be quite an easy choice. Andy, so back to you to close off for us. We haven't talked about Asia. Let's just talk about that from the demand perspective. We haven't talked about it much today. Just to wrap up, in terms of the remainder of Q4, we've seen China, even by its own admission, come out to say things are slowing down. It's temporary, but that's just the way it is. And from a jet fuel point of view, let's talk about Asia opening up and travel. We saw pretty good recovery in jet fuel in the last month. Do you see that increasing, continuing? And how much, how's the market viewing Asian demand for the next quarter or two?
So I think how Asia picks up and actually more importantly, how robust its pickup is very important to the future. I think everybody wants to be optimistic, but needs to be a little bit pessimistic, because the last thing you want to do is make these big assumptions that everything's going to start opening up, demand is going to start growing, and then suddenly you see a whole bunch more lockdowns. So everybody, I think, would much prefer, the market would much prefer to see this steady return to normality rather than the whipsaws of, oh, we got it wrong, we've got too much, oh, we've got too little, oh, we've got too much. So steady as she goes, and that doesn't matter what you're looking at, whether it's the OPEC crude, whether it's jet demand, whether it's the recovery in East or West, steady as she goes is probably the best message to take away.
Okay, and I want to keep you just for one more minute, Andy, just to get your Middle East perspective on, and Randall mentioned the Q3 budget surplus in Saudi, the finely backed Gulf economies that, got their coffers filling up, not going to give that up anytime soon. And a lot of positive news on the stock markets regionally here as well, which have all had a great year, like everywhere else. But do you expect that to continue, that positive sentiment across Middle Eastern stocks and IPOs?
I do. I mean, in the longer to medium term, I expect the balance of power is going to move away from the West to the East. That's kind of clear. I think if you look at the crude markets, the balance of power is going to move away from the East and the West to the Middle East, because the reality is OPEC are going to be the producers that will continue producing. When you've got the international oil companies who are going to reduce their production, the Middle East can't. The Middle East is going to continue to do it. So effectively, OPEC's power will increase over time. And it's very, very important for them. Then they set the stage for what they're going to be as their market participation, their market share actually will start growing, which is what I expect it to do as other regions start to reduce their production.
Thanks very much, Andy, Laban, Vandana Hari, and Randall Muhammad. We just want to draw your attention to the halftime talk, which will be playing imminently. Today, that's an interview with Mr. Mehmet Ergüçü, and he gave us his insights on a lot of across the region, on the US and China's role in the region, on OPEC Plus's power, becoming actually more influential now that it's expanded, and also giving his thoughts, a few thoughts on COP26 and the imminent demand there of what needs to be done. So a very interesting interview coming up, which will be airing at 11 a.m., I believe, as we close up this session. So thank you very much to our three regular guests for their insights, and for our viewers, and have a great remainder of the week. Thank you very much.